Over the years, I've had the opportunity to see several actual cases of fraud. I used to be a registered investment advisor. I have an MBA in finance and investments, and I know a little bit about this, and I wanted to share what I've learned over the years with you guys. There are 7 common signs of fraud that I've noticed. You can see them listed here. We'll go through each one. I'll give an example or two for each one and just talk about it for a second. The first one is anytime someone presents to you an opportunity with abnormally high rates of return, where the rate of return is way higher than other investments of that type, it should be a massive red flag. Um, for example, anytime anybody tells you that you can make 30%, 40%, 50% on a very low risk investment, those two things don't go with each other. I'll give you some examples of common levels of return for different types of investments. For example, depending on which markets you look at and which time periods you look at, you're going to see long-term average returns in the stock market between 8 and 15%. For bonds, you're going to typically see over the last 10 to 15 years the returns that kind of go between about 2 and 10%. If you look back to the 1970s, you had bond returns in the 20% range, but in kind of the recent past, you would have seen 2 to 10%. People that do stuff called hard money lending, that's just nice loan sharks. When you can't get a loan from a commercial bank for some type of commercial venture involving land or some type of collateral, you'll find people that are looking to earn 15 to 50% plus maybe an extra 10% of your investment up front to work with people outside the commercial bank range. If you get a payday loan from one of those stores that have been popping up all across the nation over the last few years, know that you're going to pay a significant amount to them. And it may not seem like very much for the short period of time, but if you annualize it, these rates of return that I'm talking about are annualized. Pawn shops and those payday loan stores often charge in the 60 to 120% per year. We're like, how could they do that? Well, oftentimes pawn shops will charge 10% a month. When you take an item in, let's say that it has a market value of $400. In their mind, they might give you a $300 loan against it, and unless you make your 10%, a $30 monthly payment, you forfeit that thing. Real estate, the kind of returns you're going to see there, it's going to track inflation over the long term, plus availability. When you run out of land in desirable places, then the prices are going to go up beyond that. That's why if you look on the coast, particularly in California where the weather is so nice, you'll have some larger returns, but some of those opportunities are limited because there's not a lot of beachfront and attractive space in places where it's still super attractive. Inflation over the last 10 to 15 years has been about 2 to 3% a year, and so most investments have had to return or should have returned at least 2 to 3% a year just to avoid losing money to inflation. That's something else to keep in mind. And once again, we see that inflation was up in the 20% range back in the 1970s. When we talk about bond returns being up in the 20% range and interest rates being up in the 20% range in the 1970s, it's because they're correlated. Interest rates are a function of two things. First, inflation. If you aren't charging somebody on a loan at least as much as there's inflation on an annual basis, you're basically giving them money. So interest rates are made up of inflation plus a risk premium, and that risk premium is a function of how risky the venture that you're investing in is. To give you a sense, about 8 years ago, I was a controller for a software company. We were a $40 million worldwide software company, and we took out a 12% loan with a venture capital group just to have some money sitting around in case we needed it. I don't know if we ever tapped into it. I don't. When I was there, we didn't. But a 12% loan just to have that money on hand. I worked years ago at Ford Motor Company. I was in their finance department, and their calculations were that their investors expected about a 13% annual return on their stock. I had a friend who worked in the finance department for General Chemical. They expected or anticipated that their shareholders were looking for about a 13% annual return. So you start to get a sense for, what for different investments, what kinds of returns people expect. Now take this into account too. If someone says, well, you know what, GE and Ford pay their look at about a 13% return, so I want you to lend me $100,000 so I can go make cars in my garage. Well, your brother-in-law making cars in his garage is vastly more risky than it is to invest in Ford Motor Company. Even if you like Toyota and Honda a lot better, it doesn't matter. The scale and the success of a company that's been operating for a long time present a materially different risk profile than a startup with no experience, no proven track record to make products or sell them successfully in the marketplace. So anytime you're investing in something small and new, the risk does go way up. And just so you know, there's always an inherent difference between equity investments and debt investments. Equity, it's kind of a best efforts. If they can make some money for you, great. They make it. If they don't, there's no promise. Debt, you have to make that payment. If you don't make your debt payment, the creditors will take over your company. So there's an adversarial relationship whenever there's a debt investment where that doesn't really exist. Equity, you're an owner in the business. You want it to be successful. In bankruptcy, the debt holders always stand in line first, and the equity holders always stand in line at the end. Well, actually, the bankruptcy attorneys stand in line first, and then the debt holders, and then the equity holders. And that's why you'll see that typically the required return on debt for a company, so if Ford Motor Company wants to make their equity holders 13% a year, they're going to pay less than that typically when they borrow, and that's because there's less risk for debt. Why? Because if the company goes out of business and they have to liquidate the assets, the debt holders stand in line first to take that money. The second thing is, if someone says they have an investment where the money is needed rapidly or quickly, they need the money right now, or people need quick access to money, and because they need that quick access to money, they're willing to pay disproportionate rates of return, be very careful. About 15 years ago, I had a friend, and he had had some problems, some run-ins with the SEC in his life, and he gave me the transcripts of when he had his SEC trial. He was actually banned for life from selling securities, so I read through this stuff with great interest. The loan scandal he got involved in was called the prime bank loan, and there was a lady who was a vice president of the World Bank who was taken in by this. So it's not just unsophisticated investors that don't understand these things. The whole scam was that they were getting money from investors because large banks, needed money quickly for some short-term needs, and they were willing to pay disproportionate rates of return. I think it was about 10% a month. They were promised 5 or 10% a month. Massive rates of return in terms of traditional debt financing. It was totally bogus. These guys had, if you understand that there is an overnight bank market. See, banks need money on a short-term basis because they have reserve requirements on a daily basis that they have to meet. And so based on how much cash or based on how much money went out of their bank that day, they might, at the end of the day, if they close at 5, at 4:30, they say, hey, you know what, we're going to be short today to meet our reserve requirements. So they would call banks around them and say, hey, can we borrow some money? Do you have any excess reserves? And other banks might have it, and they would lend them to them on an overnight basis. Sometimes they would pledge as collateral treasury instruments to do this. But the bottom line is there's a mechanism for these banks already in place to get large amounts of money very quickly on a daily basis for their needs. And so this whole need for quick money was totally bogus. If they had understood the way the capital markets were already meeting the needs of those banks, they would have understood that this was completely fictitious. There was also the commercial paper market for large corporations in that time frame. If you needed quick loans for 60 or 90 days, you could put, if you were General Electric, you could put tons of, millions of dollars of debt out there on a very short-term basis to get money quickly. So once again, if you understand that there are lots of mechanisms in place, particularly for large institutions, to get access to money quickly, anytime someone says they need money quickly for large institutions, totally bogus. The third thing, and this is one of the biggest hallmarks that I've seen of consistent fraud, is that if something is a secret, that's totally bogus. When people want money, whether debt or equity, funding, they have no problem, and they're legitimate. They want it. They'll talk to as many people as will listen to them, because the more people that are interested, the less they have to pay those people to invest. So almost never does someone have a legitimate reason to keep something secret. If they tell you that you can only share the opportunity with a limited number of people, be very, very careful. So I had a friend, I lived in the Midwest about 15 years ago, and I had a friend, and he was involved in this thing. He met some people through his church, and the guy who was in charge had been a leader in their church, so he totally trusted him. That's one of the hallmarks we'll see later on, one of the other indicators. And this guy had an investment where they had to sign something that they would keep it secret. They wouldn't tell anybody. When they told people about the investment, I wanted to find out more about it because I was skeptical of it. They found out a little bit about me, that I had an MBA with an emphasis in finance and investment. They wouldn't even give me the information to look at it. They were very convincing because they had monthly statements they printed out. It was all completely and totally bogus. But my friend was not allowed to disclose the details to me, and so it was very hard to find out what was actually going on.